I'm delighted to welcome you here to the Center for Global Finance Research Seminar this today. I'm very delighted to see within the audience quite a good number of friends from across the world, including our partners in this project, in particular, Professor Joseph, because it's very late in India right now, but he's been able to make it to this meeting. Perhaps before I introduce the speakers, I think it would be in order for me to say something about how this paper fits into the grand scheme of things. This paper is a part of a large research project entitled UK-India Bilateral Trade in FinTech and FinTech-enabled Services, Emerging Trends and Potential for Growth, which is funded jointly by the UK ESRC and the India grant body ICSSR. I hope you can see what I'm sharing, right?
Yes.
Yeah, good. Now, this is again, there has a number of partners here, including the Gulati Institute of Finance and Taxation, GIFT, the University of Central Lancashire, UCLAN, and Philip will be joining us for presentation in due course as we start. The Institute for Studies in Industrial Development, SOAS, then the Research and Information System for Developing Countries, RIS, University of Essex, and Twimbit. So there is quite a consortium type of funding here, I'm delighted that many of the contributors to this project are able to make it in the presentation. And now I think it's appropriate for me now to introduce the speakers. This will be a two-person drama with both Ahmed and Philip doing the presentation. We are fortunate to have these researchers here sharing with you the work that we are doing. So let me first introduce Dr. Philip Kostov. He is a reader in quantitative economics at the Lancashire Business School at the University of Central Lancashire, and has, overall his qualification, a PhD in agricultural economics from the University of Newcastle upon Tyne, and has published very prolifically in top journal, the Journal of Agricultural Economics, European Review of Agricultural Economics, Scottish Journal of Political Economy, and others. And his current interest now is in the area of fintech, and especially focusing on fintech, but spreading into other areas of his specialism: spatial econometrics, model selection issues, quantile treatment effects, counterfactual distribution. I could go on and on, but Philip is a very a leading member of this group, and also we are delighted to welcome him here today for this seminar to share with us the research progress. And the presentation will also be done jointly with the Ahmed Khan, who is already in the audience as well. You've seen him just about to start off. He is a research officer of this important research project. He obtained a BBA from the Institute of Business Administration in Karachi before working as a portfolio manager at Bank Arfala, which is a major commercial bank in Pakistan, hence combining academia as well as practice, and also obtained an MSc International Development, specializing in public policy and management from the Global Development Institute at the University of Manchester. Now, also, as Ahmed will be explaining, the paper includes quite a number of co-authors, collaborators on the project. And I think we'll see Arun, Sankom Arun from Essex, Sherry Makos, whom I have already seen, I think, yeah, she's in the audience right there, and Professor Joseph, who is also with us. Okay, so Ahmed, you please start the ball rolling. As I said, it's a two-man drama, and Philip will join in due course. So let's put our hands together and welcome you to start the presentation. Please go ahead.
Right. So thank you very much, Dr. Victor, for the kind words. Really very courteous words. As been introduced, my name is Ahmed Khan. I'm currently working as a research officer for this project, UK-India FinTrade. I'm a full-time staff member for the University of Essex as part of this project. And without further ado, I'm just going to start with screen sharing the presentation that we're about to present.
Yeah, excellent. Do you want to put in presentation mode?
Yes, I'm just about to. There's just a bit of a lag that I'm getting around. Okay. I hope this is visible to everyone. Screen sharing from my end. And this is the presentation mode.
Yeah, thank you. Thank you.
Okay, perfect. Just for the sake of having a more secure internet connection throughout, I'm going to stop my video sharing at this point in time, but the audio will definitely be heard throughout, so that should be good. Right. So what we're talking about today, what we're presenting today between Philip and myself is a research paper titled Trends in Trade and FDI in FinTech and FinTech-related Financial Services. It's been drafted and prepared through the collaboration of the entire team, all of whom are mentioned below. And Dr. Victor already mentioned all the names, Professor Aaron, Professor Marcos, Philip, who will be presenting with me. We also have another research officer, Nehan, who's also here in this call right now. I would just like to recognize her as well. And right. So with regards to the paper, what we have is the exploration of a relationship, of fintech and financial services relationship between two key economies, the United Kingdom and India. And the research objectives and findings are as such. They're mostly revolving around the field of fintech and related financial services. And they want to address the digital transformation in financial markets and the significant implications that this transformation has had over the years in terms of international trade, in terms of provision of financial services. But then the paper also has to look into the themes of this revolution, which revolves around automation, which revolves around digital transformation, artificial intelligence. And it wants to look into the observation of certain environmental conditions that can promote and foster the growth in fintech and fintech-enabled services, such as infrastructure connectivity, mobile cellular connectivity, the improvement in ICT infrastructure, communications infrastructure, telecommunications infrastructure. With regards to the two economies, the two prime economies that this paper observes, UK and India, and the relationship between them, it sheds light on the respective specialization of the two economies, with UK being a core historical power in the export of financial services, as opposed to India, which is an emerging giant in the export of ICT-related services, tech-related services, operational support services, and how these two can integrate together in the form of a robust financial relationship. And certain few additional themes that this paper focuses on is the study of substitution between FinTech FDI, which is foreign direct investment, and FinTech in bilateral trade. So the complementary versus substitutional relationship between these two concepts is observed in detail. Nearshoring of industry, which has made FDI an increasingly viable alternative, that's observed. And apart from that, apart from the two main economies, UK and India, there are findings which offer implications for a number of other stakeholders, such as the European Union, such as the United States, and the UK's relationship with the rest of the world as well, from an FDI and trade point of view in terms of fintech. Just to give a bit of a flavor from what contemporary literature has to offer in terms of our research and the areas that we are exploring. A lot of research papers have definitely stressed on the rise of the fintech revolution, on the growth of the fintech revolution. And a lot of them have credited these improvements to ICT infrastructure and ICT connectivity, which paved the way for us to gather some data on infrastructure connectivity in UK and India and see how that accelerated pattern has coincided with the growth in fintech services. There is in terms of the timeline that we are considering here with regards to FDI and trade data, our timeline is mostly focused from a region of 2003 to 2022, and goes without saying that during this timeline of 2003 to 2022, a lot of significant financial events have taken place. The 2008 financial crisis, the COVID pandemic of 2019 and the resulting recession, as well as one very important unilateral event, which is Brexit, and how that has impacted the British economy, British exports, and British trade with the rest of the world, particularly also the European Union. A lot of contemporary discourse suggests that the UK has had significantly lost in terms of economic gains, financial gains from Brexit, particularly with regards to loss of passporting, and also because of which the exports have taken a hit. However, there is research that we have used to complement our findings, which suggests that Brexit, the impact of Brexit hasn't really been that bad, as you can see from Pot Piera 2021. The paper and additional papers stress on several factors which have contributed to preserving the UK's financial exports, the UK's exports of financial services and FDI and financial services. For example, the use of English as official language, existing trade agreements, and also the prospect of finding new trade agreements with new partners, for example, India, which has emerged as a very viable alternative trading partner for the UK. And currently, there's also a lot of work going on in exploring a free trade agreement between these two countries, which can foster and grow the fintech services exchange even further. In terms of the determinants of FDI inflows, now we can see that from a case study of China and India, there are some similarities for FDI determinants, such as market growth and political risk, which really shed some light on the role of regulation and how state-sponsored policies, state-enforced policies can have a significant say in the growth of FDI in fintech and the growth of bilateral trade and fintech services. And as you can see, even from a trade point of view, trade in financial services is assessed to be a critical aspect of economic and financial stability. A side focus, not the main objective of this paper, but a side objective of the research that has been compiled for this paper, is that there has been significant data which suggests a link between FDI in fintech, trade in fintech, and economic growth, and how FDI and bilateral trade and fintech services have actually contributed to fostering economic growth, GDP growth, in both the economies, in India as well as in the UK. So this is not the main objective of this paper. However, the research and the data that we have and the data that we have analyzed has actually stressed that this is also a key finding that has resulted from it. Most importantly, though, there is what we want to study was the effect of FinTech FDI and FinTech Bilateral Trade. And we wanted to see how there's a complementary versus substitution relationship between these two phenomena, complementary versus substitutional between FDI and bilateral trade and FinTech services. Now, the literature here was essentially limited. There wasn't significant literature from a FinTech and financial services point of view, owing mostly to the fact that the FinTech revolution is new, it's unique, it's still novel, because of which the literature doesn't explore this relationship in that much detail. There have been quite a few papers that we studied which found trade and FDI to be complementary rather than substitutional, but this was in the case of other industries, manufacturing industries, as well as the conventional banking industry. There is some cause to suggest that there is a substitution relationship. For example, from the paper in 2009 by Chang and Gale, which suggests that there is substitution of trade with FDI in countries which exhibit higher forex market volatility, perhaps. So this just suggests that there are factors which determines the overall nature of the relationship, either that being a complementary relationship or a substitution relationship. But one thing is that we've noticed from our results is that the concept of nearshoring, a new phenomena rather than offshoring, is definitely taking shape, where bilateral trade is actually being replaced by FDI in financial and fintech services, particularly between UK and India, so as to promote the concept of nearshoring rather than offshoring between these two economies. And lastly, there's always a lot of literature on the economic impact stemming from regulation, such as 2012 Murinde, which stresses that economic regulation significantly influences the magnitude of FDI inflows, determines successful FDI, and determines the successful impact of FDI, and also theoretical predictions, which focuses on institutional factors, for example, democracy, rule of law, stability, and how these factors determine a greater yield in FDI, as backed by Bailey 2018. So all of this literature feeds into the data that we have compiled and allows us to make observations and build on these findings to find our research objectives further. I want to talk about the methodology that we've used, the sources of data primarily. We used initially we used a total of 3 core platforms to obtain our data from. The foreign direct investment data for fintech related sectors and services was obtained from a platform called FDI Markets, from which we were able to extract data for all these UK, India, USA, the European Union, and the rest of the world, starting from 2003 and going all the way up to 2023. Bilateral trade data for fintech-related sectors, as well as ICT services, which is infrastructure, internet connectivity, and telecommunications data. So all of this was extracted from the OECD statistics database, where data is annual and reported at the end of each year, the timeline lasting from 2005 up until 2021. So this shows that the basic timeline that we have considered for this whole project is essentially between 2003 and 2005 and goes up until 2022, 2021. So roughly a 20-year period. Lastly, we also wanted to abstract a lot of data on the infrastructure and connectivity indicators that we pointed out would have a significant say in the fintech revolution. For example, telecommunications, internet usage, mobile cellular connectivity, and so on. And this was extracted from the World Bank database. And lastly, and most recently, because our research for this paper is ever expansive, we're always exploring new links to be made, new indicators to be assessed, and new data sources to be analyzed in order to obtain our research objectives and findings. Most recently, we've extracted fintech startup data from the Traxon database, also for the period 2003 to 2022. This is still exploratory in an exploration stage. However, this data mainly focuses on the yearly number of fintech startups in both the UK as well as India, and how those have progressed with the pace in FDI and bilateral trade, and also with the pace in regulation and so on. Just right. So what I want to do, and Philip will talk about the analysis and the research findings from the quantitative analysis that we've performed. But also before that, it's important to present some key observations based on which we have built up our research findings further and our research questions further. So some key observations is what I'm going to present right now. And starting off with the UK-India FDI and financial services and FinTech-related services, this is the data that we obtained from the FDI markets database. And as we can see, that we start through initial stakeholders, observing the relationship between UK and India. From the left graph, you can see this is a relationship of UK FDI flows to India in terms of FinTech services, in terms of total capital investment. So this is the total capital investment of all the projects that were flowing from UK to India. And the right-hand side presents the opposite relationship, which is total capital investment of all the projects flowing from India to UK, sorted yearly, of course, on a time series model. So we can see some basic observations from this model. We see how FDI flows from UK to India do constitute a primary financial services nature. And on this note, I would like to point out the way that we have sorted this list of projects. It's essentially, as can be seen in these two lines below the title, the capital investment of shortlisted projects sorted into Tier 1. Tier 1 is essentially projects having direct impact on financial services. And by financial services, we mean direct impact on fintech services. And also Tier 2, which is projects having an indirect impact via ICT contributions. ICT contributions being tech support, operations support, infrastructure connectivity support, which complement fintech services and which complement the fintech revolution accordingly. So this distinguishing nature between Tier 1 and Tier 2 gives some really important insights into the findings and the observations. We can see how from UK to India, the flows are inherently of a core financial services nature. Tier 1 projects historically had a significant chunk of the FDI flows, even though recently there has been a rise in Tier 2 projects, which is tech support and ICT contributions flowing from UK to India. Even then, we see that financial services nature is intact. And what we can deduce from this is that the UK really has served as a historical and a continuing giant in the export and FDI contributor in financial services. On the other side, from the India to UK cycle, we see how much of an evolution is going on in the Indian economy, where infrastructure investment and technological investment is yielding significant export of ICT services, more so than historical financial services. So the financial services that were there historically are being replaced by ICT FDI flows, which are gaining the upper hand. And we can see some core cycles which led to a downfall in the FDI flows. For example, the 2008 financial crisis, which led to a significant shortfall, significant deterioration, both from the UK to India end as well as from the India to UK end. Conversely, as talked about in the literature review, we said that Brexit has resulted in the exploration of new markets that the UK is exploring to trade in its fintech and financial services. And we can see how this data backs that observation by a rise in the relationship between UK and India. We can see how capital investment is gaining a significantly higher chunk, especially after Brexit in 2021 and 2022. We see just how much of significant investment acceleration has taken place between these two economies. This is just some insights from the FDI data with regards to the if you want to observe more intrinsically and more explicitly just where are the FDI flows going, or where are they going in terms of cities, where are they going in terms of which companies are the chief contributors. So from India to UK, we see how the FDI flows really are concentrated in the big cities, London, Birmingham, Manchester, taking up the core chunk of projects, London, of course, having the giant share. We see some chief contributors from the Indian side, for example, ICICI, which is First Source, ICICI Bank, State Bank of India, Punjab National Bank. However, if you flip the relationship, if we see from the UK to India perspective, we see how a lot of significant FDI flows are going not to the historic financial centers, but to new and emerging tech centers. Very all likes to coin the term smart cities, tech cities, emerging tech cities. And we routinely look at these observations and we see just how much of an accelerated investment is going into these regions. For example, Gurgaon, a small village just outside Delhi, but becoming a significant tech center in India. And also in that regard, FinTech center. And then there's also Chennai, Pune, Hyderabad, and the likes of which. Expanding the observations further is what gives rise to involving additional stakeholders into the equation, in which you want to see the observations of fintech flows and FDI flows between UK and a lot of additional stakeholders. In addition to India, we also want to see how these FDI flows evolved over time for flows to the United States and flows from the United States, flows to and from the European Union, and flows to and from the rest of the world. This is projected in the two graphs that you see before you in terms of UK FDI and financial services inflow and UK FDI and financial services outflow on the right side. In order to have a more fair observation of the evolution of the relationship, the UK to India volume had to be put on a separate axis, the secondary axis on the right-hand side, because that was significantly lower, as expected, because historically the core trading partners of European Union and USA would always have significantly higher capital investment quantities. But what this objective achieves is that it nevertheless allows us to observe the nature of the relationship of FDI flows. And we see just how after Brexit, there is a rise in FDI inflows post-Brexit, with US and India being the chief contributors. However, this might suggest that the UK relationship to the European Union is deteriorating. But on the other side, when we see the UK FDI and financial services outflow, we see that post-Brexit, there has been a boom in outflows, not only to India, not only to the US, but also to the European Union. And these accelerating trends is the main observation over here. And it suggests just how much of the Brexit negative impact might have been exaggerated. Just how our findings and our data suggest and our observations suggest that there might just be a converse view on this matter, an opposite view on this matter, whereby after Brexit there have been significant improvements in not just FDI inflows but also FDI outflows from the UK in terms of fintech and financial services. Of course, when there are shocks such as the 2008 financial crisis, such as the COVID pandemic in 2020 and 2019, we see that those shocks were resonated throughout across all the stakeholders in terms of both inflows and outflows. US, European Union, India, all of them suffered. However, only recently, all of them are rising. And this gives a much favorable view of UK's financial services and economic prospects after Brexit. The third variable that we want to present some observations on is, of course, we talked about FDI in financial services and fintech services, but we also want to talk about bilateral trade in finance and ICT services. As we talked about in the methodology, that this data was extracted from the OECD statistics database, and extracting all this database all this data included data extracted for core financial services, insurance and pension services, which is IPS, and also ICT services, which always serve as a strong support to the fintech revolution and fintech development in the UK and also all the other economies. We see these two graphs projected, which represent the UK finance and ICT exports and UK finance and ICT imports, respectively. Even in this, we have followed the same display parameters of projecting the India volume on the secondary axis, attributed to the fact that it is, again, significantly lower compared to export and import volumes with the European Union, USA, and the rest of the world. This, of course, can be attributed to the fact that the UK and India relationship, while right now it's significantly strong and expected to become much stronger, it's still quite a new and quite an up and coming phenomenon, which wasn't there previously. In terms of the exports and imports, we always see a rising trend across all the stakeholders. We see how now this is what gives rise to the speculation that when we talk about substitution, we say the hypothesis suggests that bilateral trade in fintech services is being replaced by FDI in fintech services. However, we nevertheless get to see that exports and imports for finance and ICT services is still on the rise, be it UK finance and ICT exports or be it UK finance and ICT exports. The absolute numbers are still progressing favorably upwards. Shocks such as the 2008 financial crisis, such as the COVID pandemic and resulting recessionary phase, they're always there. They're still represented by dips in the graphs, in both the graphs that we see. However, following that, we still see in 2020 and 2021, we see favorable acceleration across all stakeholders. So even if on absolute terms, bilateral trade in fintech services and finance and ICT services is on the rise, is still accelerating, is still increasing, the volumes are still increasing, the question remains that on a relative term, is the substitution taking place between bilateral trade and FDI, as we want to find out. Sorry, just 1 minute. I'm going to get some water. Right. So, now moving on to the fourth data source, which is infrastructure connectivity data. And this is something that we talked about in the literature review, where we talked about the regulatory factors, but we also talked about the infrastructure connectivity factors, these indicators which represent advancements in finance infrastructure, in tech infrastructure, in operational infrastructure, and how these indicators have contributed to accelerating the fintech revolution, to bringing on a more improved exchange in fintech services, both from an FDI perspective as well as from a bilateral trade perspective. And this can be seen in the form of a number of indicators whose data we extracted from the World Bank database. Before you is a visual display of 3 of those indicators. Actually, these are the 3 indicators that we extracted data from, and we made observations on them accordingly. The first one being fixed telephone subscriptions. We see this as a dying medium, one which is prone to being immediately replaced across all the economies, across all the stakeholders under observation. India, the United States, the United Kingdom, the European Union reached its peak around 2004 or 2006, but since then there has been substantial decline. And we attribute that to a substitution of its own sense, a substitution taking place where fixed telephone subscriptions are being replaced by a surge in mobile connectivity and mobile subscriptions and mobile cellular services. Now, for that, we see how these the surge in mobile subscriptions really happened during a period of 2000 and 2010, where a lot of significant acceleration took place across all these stakeholders under observation. Recently, following 2010, there has been more of a stagnation. However, it does suggest that the overall numbers have essentially reached the saturation phase in this very digitally enhanced era that we all live in. It would be hard to find any individual without a basic smartphone with which to make calls, with which to connect to the internet, with which to um, engage in services on the internet. And we can see that across not just the developed economies of European Union, United Kingdom, and United States, but also for the developing and emerging economy of India, we see just how mobile subscriptions have penetrated across the entire population in order to essentially get people more connected to the financial services sector and the fintech sector accordingly. Lastly, and most interestingly, we see an indicator which suggests the internet usage as a percentage of population. And we see just how much of an accelerated growth has taken place in India in this indicator, particularly from 2010-2012 onward, where slow rise in the internet usage as a percentage of population was made significantly faster. And especially from 2018 to 2020, we see a massive acceleration in the internet usage as percentage of population in India, where most of it has pretty much reached the saturation point for all these economies, India as well as the developed economies, United Kingdom, European Union, and United States. These connectivity factors this connectivity data has then been further analyzed in order to see how this has contributed to the fostering and growth of the fintech services, of fintech-enabled services, and how this has given rise to the overall financial services and fintech exchange from a bilateral trade perspective as well as from an FDI perspective. And this also feeds into the question of environment and how the proper infrastructural and technological environment can foster this growth and how it can lead to a greater entrenchment of the fintech sectors and the financial services sectors and industries across all these economies, particularly, again, for the purposes of the research paper, particularly the United Kingdom and India. So a fifth indicator, which is still in the exploratory stage, we can say, it concerns fintech startup data. As we talked about as I talked about at the very start, when I talked about the methodology and sources of data, I talked about how this is relatively the newest concept that the research team is still observing. And it focuses on the analysis of data extracted from the collection software, a software that we are subscribed to for the extraction of data on companies which are registered across all industries. For the purposes of our research, it's the industries of fintech, insurtech, and fintech and financial services. So we use the traction software to obtain data on nearly fintech startups across both economies, across the United Kingdom and across India, in order to have a similar timeline as to the other sources of data. We extracted this data over a timeline of 2003 to 2022, so roughly the same 20-year period that we're dealing with. And some of the preliminary observations and results are before us in this regard. So in terms of the yearly fintech startup, we see how technological advancements, infrastructure and connectivity improvements across India, across the United Kingdom, have significantly given rise to a lot more startups in both the economies, primarily fintech startups. If we see how, in the case of India, from up until 2012, there was a respectable rise in the number of startups, but following 2012, 2013, there has been a significantly accelerated rise in the annual number of startups. Uh, there is a very noteworthy dip across both the graphs from 2021 to 2022, and that's something that's still being explored as to why this dip has taken place. One of the core reasons that this could have been is because since 2022 is so um, it's the most recent year, and we are in 2023 right now. So it might be possible that the software itself has had yet to update and include more startups across this year. However, the reasons for which are still being stressed upon and still being compiled. But at the same time, the chief observations cannot be ignored, which is that the significant acceleration in the yearly number of startups only took place after 2015, and that stresses on the enhanced fintech revolution in the 2015 to 2021 period, which has been promoted by a number of phenomena such as the COVID-19 pandemic. We see how there's a significant rise in the number of startups in India after 2019, 2020, because obviously the COVID-19 pandemic has coincided well with phenomena of staying home, using as opposed to going out and using brick and mortar services, substituting that with using online services for financial services, for fintech services, and so on. So we see how these recent phenomena have really has created new fields, new avenues in which to engage in and in which to provide financial services and ensure. And on that note, a lot of these fintech startups, they are of a very diverse nature. They can range from services ranging from digital lending to neo banking, digital banking, small finance banking. A lot of them focus on offering payment systems to customers and also to businesses accordingly. A lot of these startups focus on offering insurance services, lending services to consumers and businesses and SMEs, small and medium enterprises accordingly. So in terms of the fintech industry, it's just a very expansive industry with more and more avenues being presented every day. And that is what's going to be very well correlated with the rise in the number of startups. Another observation that we managed to extract from this from the Traxon software, and the observations for which are presented in the latter two graphs, is the distinguishing between funded and non-funded companies. So funded, essentially from a terminology perspective, funded companies being those which have gone to the public markets, which have gone to various institutional investors, private investors, and have raised significant funding for the provision of their services and for the expansion of their business models. Across the board, we see how the ratio or the composition of funded companies to non-funded companies, the funded companies representing in the orange color and the non-funded companies representing in the blue color, we see how that ratio has more or less stayed the same. So as to suggest that there's not been a massive acceleration, even though there has been in the absolute sense, there has been a rise in the total number of funded companies, as the total number of funded companies are definitely going up, which suggests positively on the ability of the fintech sector to successfully raise public funds, private funds, which reflects on institutional confidence, which reflects on investor confidence, and positive industrial output and outlook. However, from a compositional sense, if we compare this to the number of non-funded companies, which have also gone up in absolute terms, that ratio has mostly stayed the same. So as to suggest that even though in absolute terms the funding ability has significantly improved, it's still not to say that a lot more funding is going into these companies that wasn't previously going in, and that might limit the overall takeaways, that there is a lot more investor confidence, that there is a lot more um, institutional confidence and a favorable outlook. It can be attributed to the fact that there is still quite a bit of volatility in the fintech sector as a whole. When we talk about services such as cryptocurrency, such as Bitcoin, and such as the new and upcoming avenues of central bank digital currency and digital lending, in terms of cybersecurity, in terms of market volatility, in terms of uh, the threat of competition, in terms of the lacks of digital connectivity and the problems in digital connectivity, there is still a lot of work to be done. And that can be one of the additional takeaways and one of the additional observations from this entire scenario. Of course, again, as I've mentioned, that this latest data source, the fintech startup data, this is something that we have not yet included in the results and the analysis that is to follow, which Philip will just very soon be talking about. But something which we are looking into expanding into the research and incorporating into the research, so as to see if it complements the research objectives and the research findings further. So, Dr. Victor, I think that is the end of part one. And I guess we can just wait for Philip to present the rest of the findings and the results and the analysis.
Thank you so much, Ahmed, for sharing with us very interesting, first of all, literature review, insight into the key issues, the literature in terms of what do we know right now, and then motivating the introduction of data. These data sources are very interesting and novel. And what is specifically interesting is the time dimension that one is able to go into as 20 years, starting from 2003 up to 2021, and also get granular monthly data plus some aspects of annual data. But even then, be able to go into a micro level insights of which companies in the UK are trading in fintech with India, and which Indian companies are trading in fintech with the UK. Also insightful. And then ending up, by the way, exploring both dimensions of FDI as an important company that feeds into fintech. And then finally ending up with the insights about fintech startups and the trends that have been emerging in the last 20 years. And of course, the COVID shock having extraordinary dramatic impact on fintech startups. Now, maybe we can have a couple of observations, a question discussion. Also, I could call upon our other colleagues, Sherry, Thankum, or even Nihan, just in case they wanted to add. And Philip will be joining us in about 90 minutes. Yeah, and a post-question discussion in the meantime. Okay, Jaideep. Jaideep is a colleague here in finance in the Center for Global Finance here at SOAS. Please go ahead.
Thanks, Victor. Thanks, Ahmed, as well. I just wanted to ask, from looking at this traction data, it seems that it should be possible to find out the proportion of these FDI and trade flows rather than like the share of the UK in the trade flows and FDI into India rather than just the absolute numbers. Because I'm supposing that might be something that will give us a different kind of insight than this absolute kind of trend that we see sort of globally for increases in fintech investment. So I was just wondering if there's something that can be done based on this data set that you've just discussed. So that was like my first thought when I saw this data. So just thought I'd ask now.
Yeah, thanks very much for that observation. In view of proportionality and, of course, in terms of the financing, also the leverage factor, but it is, I think, the proportionality that might influence. Any insight from?
Can I just jump in there,
Yeah,
Victor?
please come in.
Yeah, the traction data about the financial startups, right, in FinTech and FinTech-related services, in ShortTech and so on, in the UK and India, that is just meant to show, it isn't about, of course, this has nothing to do with FDI as such. These are just the startups that individually, um, uh, the companies that are involved in each of these countries, to show the ecosystem, the fact that both of these countries are very in terms of the, like we talked about infrastructure, connectivity, 5G and that sort of thing. But we're saying, in addition to that, what encourages either FDI or trade is the fintech startups themselves. Now, what could have been interesting, I think, that Ahmed could finesse on, is that in the funding, we have data on how much of the funding is actually brought about by foreign venture capitalists and so on, right? So we have a problem with the traction data, that the actual funding rounds, they say what is the total funding that was raised, and they sometimes talk about, in some cases, they say, in some cases of the startups, they say, how much of it is actually being funded by venture capitalists or anything. We're now trying to dig deeper, and in fact going back to them and asking them, this isn't the case. They don't supply the full data set on the funding itself and the sources of the funding in all cases of startups. So we have a little bit of a black hole there in terms of the funding, because that but the FDI data is not from Traxon at all. The FDI data is separately from the Financial Times data. They are the data providers. FT is the data provider for the foreign direct investment data, which is the slide that Ahmed is just moving to, which says at a micro level the names of companies and the projects involved in the India to UK, UK to India sort of micro level. So you can see that there are very many established companies like Wipro, Tata Consultancy, and so on. And I don't know whether Ahmed is sufficiently sort of factored out how much of the FDI is conducted by the established companies, the big tech, as it were, from India to UK, and how much of it is actually done by newbies, the startups that occurred in the last 5 years or so. Our suspicion is that, I think we need to sort of nail this down more cogently, is that a lot of the big money in FDI is done by already established companies like Wipro, Tata Consultancy, and so on. This is India to UK. And from UK to India, you can see for yourself, the big names are Standard Charter, Barclays, again, big players. I would say there are only one or two small players in the top 10 tier or top 15 tier. But nevertheless, the huge growth of startups in both of these countries, which adds to the general, in addition to saying, oh, is it ICT enabled? In other words, all the connectivity infrastructure that we discussed, we're adding on the ecosystem of tech companies and fintech companies in both of these countries. We're adding to the general environment of this sector.
Thanks very much, Sherry. Very, very insightful on the data. Very insightful addition. We have another hand. Professor Srai Tumine from Makerere University Business School. Please go ahead.
Okay, thank you so much, Professor Victor and the presenter. Mine are just, I want to, every reader or listener would want to look at the real impact in absolute terms, because I wanted to base myself on the two objectives. Objective number 2, and the last objective the presenter showed us at the beginning. Yes, for the trends we have seen, we can see the trends from other countries. But now one would want to know, okay, the last objective was about jobs created. So how many jobs have been created from other countries as a result of either an increase or a decrease in this kind of FDI resulting from the FinTech kind of. So what is that capacity built, jobs created, especially within UK and maybe especially within India as well? And also, in what sectors have these jobs been created? So that if we are to make a policy, let's assume it is UK or India, if it is to be a policy, 1, how many jobs have been created? 2, in what specific sectors is it, what are they? So that a policy person can quickly say, our dealings can be confined in A, B, C, D. And if we are to replicate, let me say in Africa, where would the focus, for example, be? Maybe if that one could come out, somebody can actually pick more or much. Thank you.
Thank you very much. Can I take on some 2 comments and then come back to the team? And apologies to my good colleague Juan. I didn't say that. I didn't see you come first. So apologies. You are number 1. And please go ahead. Yeah.
Don't worry, Victor. Thank you so much for the presentation, because it shows that, substantial effort in dragging out different sources of a database and then try to give a better picture, from your hard working. My question, because I'm from international business background, so that's why I'm pretty interested in foreign direct investment. But what I have seen here is pretty much actually, in a very general sense. So my comment is that also related to the previous question about the impact, because one of the key part about FDI is to think about the entry strategies. So it will be interesting to know, given the hundreds of projects that have been implemented from the 2 countries, what are the main entry strategies or operational strategies they have been, using, and then how this would affect the impact of their investment. So this is quite down to, the firm level or industry level in the more detail. So that's just one of my concern and also comment. Thank you.
Excellent. Thanks very much. I think that the spin of AB is very, very relevant because, yes, we have the numbers. We need to interrogate them and get some answers. Now, if you allow me, I'll take the comment from a good friend, Professor Joseph, and thanks for being able to attend in time of the time difference. And then I can come back to Ahmed, Sherry, and Sankom if they want. Okay. So please go ahead, Professor Joseph.
Thank you, Victor. First of all, my congratulations to Ahmed Khan for this very insightful and informative presentation. I will try to develop a story out of the key observations coming out from the presentation. The first observation is in terms of the number of startups. Both countries, the number of startups is quite similar in terms of funding status also. When we come to the investment in financial services, so there is an overall increasing trend across cross-border investment in financial services. But if we take a last few years in financial services, especially in the tier 2, the investment from India is increasing very significantly. So this is an important observation. The third thing is investment destinations. So investment from India, it's mostly on financial hubs like London, whereas investment from UK, it's on technology centers like Bangalore, not the financial centers like Mumbai. And the fourth observation is in trade in financial services. If we take UK's exports to India, it's not very significant as compared to UK's export to other countries. But if we take India's exports, then it is growing very significantly, especially after 2016. So what does these observations say? So I would say that FDI, if you look at the objectives of FDI, there are two purposes. One is market seeking, second is resource seeking. So I would say the investment from India to UK, it is more of market seeking. So they have acquired the capability, they are investing there. So then this is leading to increased exports from India to UK. And that is why we see that India's investment mostly is focused on places like London. Whereas the investment from UK to India, it seems more of resource seeking, more of technology seeking kind of investment. That is why they are focused on technology hubs. Okay, and probably that is why we do not see the kind of exports from UK to India, despite both countries having similar, almost similar number of startups. So this is the story that I would develop. But again, I will be a bit cautious because the FDI database that you have used, it is not the actual flows. They are the announcements made by the investors. It is not necessary that actually those investments have been materialized. To give you an example, I did a study on FDI inflows into India in the R&D area. What I found was that out of the total announcements made, which is captured in the FDI markets database, only less than 10% is actually materialized. Okay, so when we use this database, we should be aware of that, and when we interpret the results, then we should be, what to say, that should reflect our understanding on the limitations of the database. So that's all from my side. Thank you.
Thank you so much, Professor Joseph. I think I find your insight very, very interesting. Very relevant. In fact, it's always you get the numbers, and then they had to question the interpretation and building a story around the numbers. I think your insight, together with insight that Juan gave us about from IB, absolutely helpful. In the interest of time, if you don't mind, Ahmed, Sherry, and Arun, maybe you can come in later, but we need to give Philip a little bit of time to share with us what he has. But before Philip starts, there is a good relevant comment by Fatima Jika. Fatima, do you want to put your points across or in the chat? Where is Fatima Jika? You can unmute and share. Okay, Fatima has important kinds about, the interest to know the returns from these sectors, so as Prof's losses related to the deep investment. Again, very relevant, subject to the relevant data being obtained, because all investments have are geared by return and risk. In the cases, looking at it from the portfolio finance sense, so that's when it becomes relevant. Okay, so with that, I have pleasure to invite Philip. I introduced you, Philip, in your absence. So they already know who Philip is from UCLAN and part of this research. So I think please go ahead and continue.
All right.
Yeah.
All right. So essentially,
fantastic.
What we are trying to do, let me make it even bigger. Great. So we try to do some simple kind of, well, not so simple analysis of the foreign direct investment and the way it evolves the bilateral foreign direct investment between India and UK. So before going there, we needed to establish some kind of baseline story of what our expectation, what is happening. So we talked during this with a project with different kind of stakeholders and players in this game, and we got a relatively kind of straightforward story. But before I go to the story, it is kind of important to look at the one of the motivations for looking between this bilateral kind of relationship between India and the UK is because these are two countries that stand on diametrical kind of opposing ends of a pole. India, as we know, is one of the biggest kind of service exporters. In particularly IT services and so on. While the UK is the biggest in one of the biggest in relative terms exporters of financial services. So if we're looking for financial services and services supporting fintech like the IT, pension services, insurance, and so on, we have two countries that are very big players, and they're contrasting because they specialize in very, very different kind of things. So the story of what is driving foreign direct investment logically cannot be the same for so different kind of countries. And if we start with talking to the big kind of Indian consultancy and IT companies, the kind of story we got from them is the story that you see here of offshoring, nearshoring, and onshoring. The whole idea being is that initially they provide their services far away from the destination countries, and when the services become more and more complex, as financial technologies are one example of this, they try to move closer. So they try to provide it from near countries. So near, not necessarily in geographical sense, but in kind of a market size, cultural, and so on. And when this kind of thing develops even further, they start providing these particular services on site within the country. So getting to onshoring. So all this process gets you of gradual transformation from exporting directly through exporting indirectly to finally what we will recognize as foreign direct investments. So this is the point of view of India to UK kind of foreign direct investment. For the opposite direction, we got a very kind of different kind of picture. So we have a lot of regulation obstacles in India that don't exist in the UK. For example, the need for sponsored banking licenses and so on. And if you look at the useful database for kind of obstacles to services, in particularly financial services and so on, you can notice that this kind of obstacles increased slightly in India over the last decade or so, compared to what they were there. So the regulations obstacles that exist in India, many of them for very good reason and so on, would prevent UK companies to providing such services kind of over the international border and so on. So if they want to get into this market, they will need to get into this particular kind of foreign direct investment. So all of these kind of things are very, very different motivations, but they translate, strangely enough, into kind of similar expectations for the dynamics of what is happening, because we would expect with both of these a certain interaction between the bilateral kind of services, which the dynamics of which will affect the foreign direct investment, because in particular to the UK inward case, they're direct kind of substitutes, and in the Indian case, it is very similar, although slightly different, as we say in the empirical kind of thing. So we expect the trading services to interact with this, and we expect certain pull factors. In particular, as with any kind of analysis, we will expect the measures of environment in particular the development of the fintech sector and so on, to pull investment into any of these countries. And the issue basically is, and this is the big issue, can we actually measure reliably the environment quality? And I will go to this because unfortunately in what I'm going to present today is work in progress, and not everything is up to my high standards and my colleagues' high standards. So what did we actually do? So we did something called structural time series model. Well, don't worry, we'll show you what it is, and which we used the monthly foreign direct investment, both in terms of capital invested and jobs created, as dependent variable. And we use certain explanatory variables that we put there, and these are the explanatory variables. We created a measure of digital connectivity. You have seen, I'm not going to get into too much detail into this. We created it by kind of structural equation models, and we used the raw data for the insurance and financial services share in the exports and exports in each country, which is total exports and total imports of services, not in general. So insurance and financial services share in total services exports and in total services imports for the country. Then we had the same ICT share in exports only, and we had the bilateral trade flows between India and the UK for financial services, ICT services, and insurance and pension services. And at the very end, the thing that we did very kind of late. Sorry, how did I get there? Yeah, the fintech environment, in which you have seen, Ahmed showed you the numbers of fintechs created during that period, and the actual kind of funding that they have raised. And the last one is a bit of question mark because, the proper data for the funding only became available yesterday. So I haven't included it in this particular result, which explains why they might be also expected. So this is what the model looks like. So it looks complicated. No, it's not that complicated. So you can you see my mouse. You can see this bit here, which is essentially a regression effect. I have error term, regression effects, and a trend, a local linear trend. So essentially, everything in this model is allowed to change over time. So, and if you look at this, which are how these coefficients change, they're allowed to change as random walks, to evolve over time. And the last line presents all these variances that say the variability of all these coefficients. Now, all this looks very complicated, but it is a model in which, a regression model in which the coefficients evolve over time, and so does the local linear trend, which is the second term. But now notice something. If some of these variances essentially become zero, the corresponding coefficient becomes a fixed one, so it doesn't change over time. So if everything except the error term becomes fixed, we get the simple linear regression model. But then we are allowed basically to have elements, some things that change over time and things that don't change over time. So it's quite flexible model, but it's too general. Why is too general? It has too many coefficients. Not problem to estimate it and so on, but the issue is that if you don't have enough data, essentially what you will have is a lot of variability, a lot of very big confidence intervals and so on. So we decided to allow the data to choose the model. We did selection. So we did selection of two things. We selected simultaneously the variance terms, which variance terms are zero and which are not, therefore which coefficients are fixed or which are not. And we also selected the coefficients for all these many variables that we put there. And selecting the coefficients, we're selecting whether coefficient could be zero or not. So how did we do this? So we did essentially use a Bayesian shrinkage methods. Now, I have put this, quite a few of them. Essentially, these results today are only used from the Bayesian lasso. So preliminary results used all the other methods, and all these were essentially equivalent qualitatively. We didn't have a lot of time for this one because it changed a lot of things, so had to do a quick and fast kind of estimation. So we will hope that later on, if we apply the other things, we'll get something very, very similar. If not, we have a problem. And then we introduce a sparsity. So the whole idea is when you use Bayesian methods, you shrink your coefficients, variances and coefficients towards zero, but technically, because of the nature of Bayesian estimations, they never become zero. So you need to decide when they're actually zero or they're really a very small number. And with kind of a lot of variables measured at different scales, this is not so straightforward. So we used a method called signal adaptive variable selection, quite kind of straightforward and easy to use. And then on top of that, we basically implemented it at each steps of the Markov chain Monte Carlo kind of estimation algorithm. So normally people do it at the very end. You estimate the model and it's one of now. Because we implemented it during the steps, we kind of account for additional uncertainty in our modeling. So this is what our results look like. Now, look at this. It looks like a regression table, and it is essentially a regression table. So because we ended up with all our kind of regression variables actually having fixed coefficients. Now, why is that? Because we have too complicated model and not enough data to do it. So what do we have here? We have three models. So what is the difference? The first two, where you have the capital in the UK, foreign direct investments into the UK, and the jobs created by this. And the last one is a model in which in the pool of candidate variables, we also put, for explaining the jobs, the actual kind of capital invested in these projects. And this changes quite a lot of the meaning, because if a certain amount of capital creates certain jobs, the rest is the additional kind of job creation capacity, to put it in another way. And now we can look at this because they are effectively, they are all kind of fixed coefficients. There is a difference. The very last one, essentially, I can go into this, but it could be due to the issue of data. The very last one is actually not a fixed, so I took an average one. So the last one is actually an effect that changes in time, but not that much. So nothing to worry about it. But let's look at this. You read them in the same way as a normal kind of regression table. So what are these essentially variables? So the first two are essentially bilateral kind of trade flows. So first one, financial services, this is FinTech, from India to the UK. So export from India to the UK, or import from the UK into the UK from India. The next one is insurance and pension services. And then the next one actually sees the share of insurance and financial services into the UK imports of services. And I will go to the last two, which are the actual funding for the fintech sector, and the established fintechs as a kind of overall number. They're measured in slightly different way. So the established fintechs, actually, you put three variables there. The actual kind of number in each month, newly created financial technologies companies, and we had kind of a rolling mean for over the last 1 year, over the last 2 years, in order to interpret kind of any differences. So what the model selected is the raw kind of measure only. The funding is the problematic one. Why is the funding problematic one? Because in this data set that we use here, we only used the last funding round for each of the companies. And many companies got through this period several kind of funding rounds. So a lot of funding is actually missing from this data. So this is the wrong measure. But fortunately, we got lucky. It got us expected kind of results that when we replace this, we will hopefully kind of find something similar. So what do these results actually tell us? So look first at the very first two, the capital and UK jobs. So we can notice that the bilateral finance flows have a negative sign for both of them, which basically means in very simple terms that we have these substitution effects. So we have this transformation of provision of services into eventually foreign direct investment, which is exactly the kind of thing that the Indian service providers told us. And so we were expecting it. Now, obviously, we got this for these two types of services. We didn't get it. It dropped out of the model altogether, the ICT kind of bilateral provision of services. But then we have to be very kind of careful because the ICT provision, it's kind of more difficult to link directly to the fintech services. A lot of these business services, a lot of ICT can be provided for more general kind of provision for companies that are not financial technologies related and so on. So this is maybe the reason why it is. So strangely enough, didn't expect this, the share of insurance and financial services, the importance of it in the UK imports have a positive effects on the jobs being created by this kind of foreign direct investment, which seems to be a consistent effect because you can see it carries over to the other job specification model. Then let's go to the actual kind of funding and established fintechs. So as it is expected, the number of created fintech companies in each period of time, month and so on, is positively correlated with the foreign direct investment. And you would expect this because it is, let's face it, a measure of the quality of the ecosystem. If more kind of fintechs sprawl around and so on, it's a more attractive kind of ecosystem and so on, and you expect this particular pull forward. Now, what we probably wouldn't have expected is that the actual funding raised by these companies is negatively correlated to the foreign direct investment. Now, on a hindsight, look at the results and so on, they make kind of sense to me because, bar that as explained, our funding measure is very, very imperfect at this stage. So, but we hope that it wouldn't change with the proper kind of data. So, because if you have a lot of funding attracted by this sector within the UK and so on, so basically you have the funding can come, think about the sector can come from foreign sources, say India, and can come from local sources. If there is enough coming from local sources, you probably have this kind of informal substitution effect and so on. So this looks all kind of very, very reasonable. What about the jobs creating capacity of this foreign direct investment? So obviously the capital creates a significant effect of all these kind of jobs, and then we have the importance of the insurance and financial sectors in the UK economy in general. Which probably is another infrastructure measure as we can interpret it. You can look at this in more detail. And then the strange kind of thing, you have the number of fintechs created having actually a negative effect. On first sight, when I saw this, I say, wait on, there should be a problem here. But then, because the funding, the wrong variable, is not selected at all, then probably there is something underlying. Then it's very useful to have a hindsight. You think, so if you have a thriving kind of a fintech sector and so on, there is a lot more competition. And we have more competition in saturated market, it might be reasonable to expect that the additional job creations from saturated market will kind of decrease, which is what this particular thing kind of shows us. And then, okay, in all these models, in addition to this regression part, we have the local linear trend element, which you can think about is the things that our kind of regression variables kind of didn't capture. So this is the additional thing that happens. Yeah, so I will go into this in a moment. So let's say what is happening to India. So I have been lazy, so didn't put the capital investment for the last model on a separate row because needed to introduce more kind of things. So essentially what we have here is very, very kind of similar picture. We have, think this green thing, this essentially substitution effects. We have the insurance and the financial services into the imports expect. We still have the negative effect of the funding, however imperfect it is, and we have a significant positive effect of the number of fintechs. Now, what we have here that we didn't have in the UK, look at this row here. IPS India to UK, we have the insurance and provision services export from India to the UK. So it is like the substitution effect, but it goes, notice, in the opposite direction. Rather than flow from UK to India with negative sign, we have the flow from India to UK with a positive sign. So if you think logically, it is a similar kind of like substitutional like an effect, but essentially what we are substituting is the kind of provision of services from India to the UK, in which if you have more foreign direct investment, particularly if you do foreign direct investment in this particular sector, which is pure speculation because we didn't look at the actual kind of breakout of these investments, but then you would imagine that UK firms, one of the reasons why they may invest in India is to boost their provision of services back to the UK. So essentially, the kind of story looks very similar, consistent with whatever we had there. And if we look at the very last thing, the job creation kind of thing, yeah, we have the same thing as before. Again, this strong kind of negative effect of having more fintechs and so on. And now I mentioned the other thing that we need to consider is, the local linear trend, which is essentially the things that the regression part of the model kind of misses to explain. So it's easier because these are kind of things that change in time to plot them against the actual kind of time. So you can look at what is happening to the, I will call it the proper trend in capital investments and in jobs created from the foreign direct investments in the UK fintech sector. So you can notice that for the UK, for jobs and capital, this kind of will look very, very similar. So they are not the same. And even the slight kind of local trends are slightly different, but you have the very, very kind of similar kind of shape, which up to like late 2016, early 2017 is going slightly kind of downwards, and then it shoots up. So what it tells us is that in the later part of the studied period, we have an additional effect in foreign direct investments in capital invested in jobs created that our kind of regression model didn't kind of properly capture. So there are different explanations for this. One of them could be that we didn't have enough data. So when you do it, the variability in the model is not enough, and we ended up with fixed kind of coefficients, and some of this variability might have happened later on. But it could be that this is reflecting essentially the underlying kind of trend in fintechs, which in the very kind of early kind of time period and so on were not kind of getting inward enough investment, and this kind of process have accelerated over the last few years. Now let's look at the same kind of thing for India, for the Indian model, and notice something really, really interesting. So while we have for the capital this increasing kind of trend over time, for jobs created over time, the actual kind of jobs created by this kind of foreign direct investment have reduced considerably compared to the relative jobs created early in the period. Remember that all of these kind of regression effects are fixed, so we are looking at this kind of average job created. So the average job creation kind of capacity of this foreign direct investment in India have reduced over time, which maybe is probably explained by the nature of this investment, which early on with kind of highly skilled ICT kind of labor and so on was sucking a lot of labor because there was great availability of this. And when the availability of labor kind of in relative terms reduces, the kind of projects and maybe the fintech matured, so it is less job creative rather than providing other kind of outputs. But this is the thing that is kind of happening, which is kind of interesting contrast between the two countries. And then, so-called job creation capacity. These are the last models in our tables. And here we can see that definitely we have this particular kind of trend very, very similar between the UK and India. So compared to our kind of regression explanation and so on, the fintechs are in relative terms with regard to amount of capital that invested and so on, are still increasing the job creation, their own kind of job creation capacity. So for dollar, because our monetary terms in this data set are dollar, for dollar per dollar, the over time, the job creation kind of this foreign direct investment has increased over time. So I'm trying to wrap up because so what do we learn from this? So first of all, we confirm the interactions in trading services between the financial services, business services, and these interactions with foreign direct investment in fintech, which is something that we expected, but before we try it, we are not kind of know. So then the local level trend is the proper trend, everything that except the regression effects and so on, is generally upward with the exception of the jobs, the absolute amount of jobs in the Indian case. But the job creation, the very last thing, we can see a transformational role of fintech. So our fintech is creating a transformation in the economy in general, creating more and more jobs that our kind of relatively simple economic models at the moment cannot capture to the full extent. As things develop, if we can provide a better and more detailed explanation of the process that drive this kind of thing, this kind of picture may change, because let's say what we have there is what the rest of the model doesn't explain, which we explain it as the changing trends over time. And that's all, folks, as I say. And we have here some links about publications and research deriving from the project. So I will probably, I'm not sure whether I should stop sharing my screen, but we are open for questions. So I will keep this thing there just in case we need to illustrate something. So thank you.
Yeah, thank you. Thank you so much. We are showing your hand over, Prof. Thank you so much, Philip, for that very exciting, very clear presentation, insightful. In fact, you answered some of the questions that were raised before your arrival. Your presentation has answered them very well. There was a comment or feedback from Professor Tumine about the impact on jobs. So this analysis you have had shows us the impact on capital and then the also jobs. So that's very well taken. There also was a question from my colleague Jaideep, who is now going to teach. He went about 30 minutes ago, but his question, his observations on the shares were also answered, because you are looking into the shares of some when you are doing actually in this, even in the conceptual framework from the model, some of the variables you are explaining are given in shares. So absolutely interesting. And it was also interesting to see quite actually a couple of things. Also the comparing the trends in the capex investment and also in the jobs creation. Maybe there is some common element where you find that basically capital and jobs, in theory, they should be linked somehow. So maybe that's the explanation, or somewhere we could look for explanation. Now, the difference, why are the trends different in India and the UK? maybe we can have that in the discussion if they use insightful from the participants here. We have quite many participants who understand those economies, much better than me. Maybe there will be some discussion on that, where the difference. But thanks so much. Very, very exciting and very good continuation of the good work that Ahmed started with, and then rounding up. Now we open for discussion, or maybe before we open, I could also invite our colleagues here. I think Sherry is always so many ideas ready to come in. Arun, or do you want to come in when some questions? Maybe let's get feedback and then we get an opportunity to come in. And if not, then I'll invite colleagues, including Nihan, who is, by the way, in the audience to also come in. Yes, Arun, I can see you are unmuted.
Sorry.
Yeah.
No, Victor, I think for the benefit of our participants, I think this is not simple a relationship between an emerging economy and a Western advanced economy. It is much more than that, because the emerging economy, and both countries have a very long tradition. So that tradition is actually well rooted in, if you think about one of the Indian companies started their branch in the UK sometime in the beginning of this, not the end of the last century, end of the 19th century. By Tata Group, they opened a office in London. So the kind of futuristic perspective shared between the business groups in both have very long relationship. And that relationship culminated in this new product of FinTech. And as evident in the presentations, the movement from the financial advantage of one country towards the technological advancement, and from technological advancement and then vice versa. And this kind of symbiotic relationship actually benefits to enhance the role of FinTech in the whole sectors. I think that's what we see here. Because if you see the FinTech in a developed economy or the trade with, you can't get similar kind of a relationship in many other contexts. It is not that popular. So it is not simply about India and UK, but it's about a country, an emerging economy with such a large human power, human capital, and then they have a very big technological power there. And the other one is a very established financial sector. So their kind of relationship actually opens up new avenues and opportunities in the area of finance and technology, I would say. So I think it's more about a bilateral study. It is about a study which can actually provide some kind of indication to the whole development of finance and technology field there. So I think that perspective is important. Whenever we see we can't, some of these findings are quite interesting, and we can reduce it to only a two-country study. It has huge implications in terms of developing into new field. That is a thought I got after listening to this presentation. Thank you.
Thank you very much, Arun. Very relevant insight. I actually, your observations are very well tracked with the storyline that emerged from Ahmed and Philip, but also explaining how we should frame and understand that narrative. So thank you very much for that clarification. And especially it is interesting to see the hubs in the UK, high concentration. I think here we identified Manchester, Birmingham, and London. It's it's not like equal distribution all around, and maybe there are some factors why those three hubs matter. Any other additions, observations, insights, even questions, feedback? Yes, Rogers Musamari. Hi, Rogers. Good to see you. Please go ahead. Yeah.
Thank you, Prof, and thank you for the presenters. I think this is quite a relevant topic and timely also. My my small contribution would just be to find out if there are any insights or how I maybe I missed out if how the authors have maybe tried to motivate the issue of both environment in terms of the policy and regulatory environments for India and the UK as regards to the development of the fintech ecosystem, both from a literature review point of view, but also from the analysis. Maybe I could have missed out, but I think this is a very good work in progress. Thanks.
Yeah, thank you. It's about regulatory differences. Yeah, who would like to come in?
Hi, I'll get this. So essentially, yeah, we are. You have to be a really stupid person not to be aware of the role of the regulatory environment and so on. So we're painfully aware of this. So at the moment in our analysis, we do not have a kind of a reliable measure for this, but we are working towards it. So in a way, the fintech kind of sector growth in terms of number of, I think, and in terms of capital being acquired and so on, are a very, very indirect and very kind of imperfect measure of the whole kind of financial ecosystem and so on. Now, we also try to kind of in our explanation way and capture the general characteristics of the financial kind of regulation and so on because of the peculiarities, the more restrictive features of the Indian system and the much more liberal one in the UK. At the moment, we do have some data for this financial, from the regulatory sandboxes, both in the UK and India, and we are thinking about different ways to try to create a measure, and particularly our project colleagues in India who are quite interested in this. So we're looking at these things. At the moment, unfortunately, I cannot tell you anything definite or anything great ideas that we have about this, but yeah, we are aware of this and we are painfully aware that this is one of the things that is very important and is missing in any kind of analysis we have at the moment.
Thank you, Philip. I can see Sherry, your hand is up. Do you want to come in?
Right. So the OECD currently has a new index about barriers, non-tariff barriers, or what they called, it is about non-tariff barriers for trade in services. Unfortunately, that data set doesn't go far back enough for our time series analysis, because it starts in 2008, in 2014. Am I right, Ahmed? So we wanted for about 20 years, but the OECD index that they've constructed about barriers, non-tariff barriers for trade in services. It's a new index, very exciting index, because it goes into the nitty-gritty of what sort of non-tariff barriers exist. Now, what is unique about trade in services, especially financial services, the non-tariff barrier in question is that any matter of sensitivity, because the high sensitivity of financial services, a country can put restrictions. There are no, in fact, they can claim the sensitivity of the sector and put a restriction. I wouldn't say willy-nilly, but for substantive reasons of systemic risk and so on, and that can't be, in some sense, overridden by considerations of having more free and open trade. But nevertheless, I think the foreign free trade agreement between India and UK I think are looking into these issues, and we need to sort of delve a little more. But how to sort of take that index on non-tariff barriers for financial services further back is the question we have. That's the reason why we didn't include it, but I think we can mention it in the literature review. So thank you for that question.
Thank you, Sherry, especially drawing attention to that OECD data on non-tariff barriers for trade and services. Roger Musamari is from the premier think tank in Kenya, KIPRA, the Kenyan Institute for Public Policy Analysis and Research. Roger, given that these are some of the regulatory things that being the largest national think tank you possibly are concerned with, and Kenya being the a FinTech hub, especially with respect to the first experiment on mobile money. Did you have something in mind that provoked you to look into this, or do you have any priors while you'd expect in terms of regulatory policies, something that may be relevant to the Kenyan case? Hi, Rogers. Yes, please go ahead.
Not quite really, but it's just a fishing expedition. You know, it's also, I mean, as we are all aware, these are things that are evolving quite fast. So I think from the presentation, I think, and also coming from a think tank that is involved in issues of policy, I think it caught my eye to just probably probe the team. But also not necessarily, it was twofold. So either from the analytical view, but also from the just the motivation of literature, just trying to compare the two regimes so that then we can be able to see if probably intuitively to speak to the fact that either the environment has been enabling towards the outcomes that we're actually seeing from the presentations. But I think once I come across something that is relevant, then I'll always be free to share. Thank you.
Oh, so yeah, thanks very much, Rogers. And it was a very good comment and feedback, especially given the earlier comment by Professor Tumwine about, we need policy coming out of it. As Philip mentioned, we are just at the early stages of the empirical analysis. And this is part of the feedback to go back and do the further analysis. We hope that by the time in due course, the final results will have a very powerful policy and practitioner relevance for the fintech industry in both UK and India, with implications for many countries. Okay, we are running out of time. Okay. You want to come in, Ahmed? Yes, of course.
Yep, sorry, I'll just have 2 minutes of your time if possible, because as you rightly mentioned, that the policy implications are significantly relevant in this scenario, and something which reminds me of our presentation that we gave on the same paper at the CGF conference in September, in which one of the very important questions that were raised were also with regards to what sort of policy recommendations or policy implications can be deduced. And I believe what we showed then was how there is a contrast in the relationship, the fintech relationship, from between the UK and the other stakeholders. So as Philip showed in the results, that when we have a substitutional relationship suggested between UK and India, this was actually not found to be the case in the other stakeholders, for example, between UK and USA or between UK and the European Union. So that's important to suggest that if you have substitution between trade and FDI taking place between UK and India, that's not to say that that's across the board, which does present important policy implications for how to structure your trade relationship or your FDI relationship with India, as opposed to other stakeholders around the world.
Thank you indeed. Yeah, very, very, very timely and very helpful. Yeah, so we are coming to the close of the this seminar. Let me very much thank the team, and in particular Ahmed, who kicked off the presentation. Very, very insightful, very clear, very rich. And then the continuation by Philip, who took us into the conceptual framework and what the numbers are saying and the interpretation of that. And of course, the contribution by Professor Joseph, who is also part of the team, and also Sherry, Professor Makos from Essex, and also Arun, Professor Arun from Essex as well. This is a very great conversation. In actual fact, I should say this is the start, the first of the papers of a series of papers coming from this research project. And it should provoke interested members to actually go on the websites for these projects and look at some of the papers in progress, but also to turn up next week where we shall be having the second a part of the presentation. I see you have your hand up, Ahmed. Yeah.
Sorry, sorry for taking another minute. Just to further your point on the publications that we have, maybe this
excellent.
slide would be important for you to talk about, because this is basically everything that the project entails, from the research papers to the policy papers. We have 2 publications so far, and the remaining 10 will also be following in due course.
Excellent, excellent. This is very insightful, and we're gonna share this with you, participants. Meng will be reaching out to you with this information. Thanks, Ahmed. And once again, thank you all, and the participants also. Thank you very much for being able to spare the time and join this discussion. As I said, there are 3 other discussions as part of this research project. There will be a paper next week, and for the next couple of weeks, we shall be having a roadshow over what is coming out from this research. And we again want to ask for your participation, continued support. Maybe I should give a chance to the leader of this project. Maybe just say one final word, Arun. Maybe to conclude the Professor Sanko Arun is our leader for this research project. You want to say something in conclusion, and then I close.
No, thank you, Victor, for giving us an opportunity to present this finding. I think it's, as we all know, that a research paper gets fine-tuned only when you present in more conferences and get the right kind of feedback. And I think SOAS and CGF actually provides a very good platform for us to present the findings, and we look forward for the forthcoming presentations in the next couple of weeks. But thanks again for hosting us. And you are also a part of our team, and I think the whole team actually benefits out of mutual conversations and our weekly meetings. But thank you once again for the whole team. Thank you.
Thank you, Arun, and thank you, everybody. I'll just give a hand of applause. Let me see the key for applause. That's okay. That's the the key for applause. Yeah, that's very much applause. Thank you very much, and bye-bye. So see you next week, same time. Thank you. Thank you indeed.